Hello, I'm James, you're watching Accounting Stuff, and today we're doing a deep dive into the cash flow statement. This is a special compilation video that I've split into 3 parts. First, we'll cover what the cash flow statement is and why we need it. Then I'll show you how to prepare a cash flow statement using 2 different methods, the direct method and the indirect method. The cash flow statement doesn't have to be scary. If you stick with me till the end, then you'll be all over it. Alright, what exactly is a cash flow statement?
First, I want to make one thing very clear. Cash and profit are not the same thing. Profit is revenue less expenses. It's the bottom line on an income statement and relates to a period of time. Whereas you can think of cash as a bank balance at a point in time. Cash and cash equivalents also include physical or petty cash, amongst a few other things. Although most conventional companies use bank accounts just like you or I might have. I also want to make the point that cash flows are different to cash. Cash flows relate to the amount of cash that has flowed in or out of a business over a period of time. Now that might sound a bit more like profit, but it isn't. When using the accruals basis of accounting, we apply the revenue recognition and matching principles. So that means that revenue is recognized as it's earned, not when cash is received, and expenses are recorded as they are incurred, not when cash is paid out. That means revenue doesn't equal cash in, and expenses don't equal cash out. The biggest reason that small businesses fail is because of poor cash flow management. Many of these businesses would have been profitable, but without having that cash available, they're unable to pay their staff, their creditors, or the interest on their bank loans, and this throttles them. That expression that I mentioned a moment ago, cash is king, is used to emphasize the importance of cash flow, particularly in small businesses. Now, I feel like I'm harping on about this, so it's time to move on, but I can't stress this point enough. It is crucial to keep a track of your cash flows, and we do that using the cash flow statement or statement of cash flows. This is one of the 3 main financial statements along with the income statement and balance sheet. We have all 3 of them here made up for a company called Chudley Cannons Incorporated. The first thing to note is that the cash flow statement covers a period of time, and we put this in the header. Remember I said that cash flows relate to the amount of cash that has flowed in or out of a business over a period of time. Here we have the year ended the 31st of December, but this could easily cover a quarter or a month. I think it's easiest to interpret the cash flow statement by starting at the bottom and working our way back up. At the bottom, we have cash at the start and end of the year, which we get from the balance sheet over here. When we take the difference between these numbers, we get the net increase or decrease in cash for the year. In this case, it's $35,000. This number is key to the statement of cash flows because what we're going to do above is explain how and why the cash balance changed over the course of the year. We're going to summarize what cash was spent on and what the sources were and reconcile it all back to this number. And we do this by breaking it all down into 3 sections. The last section is cash flow from financing activities. Financing activities include changes to share capital, borrowings from a bank or from third parties. Here we have long-term borrowings, which I assume were from Gringotts, the Wizarding Bank. When a company borrows money, there's a cash inflow, so your cash balance increases. That's the case here, since you can see that we have a cash inflow of $20,000 because the number is positive. But cash can also flow out of a business through financing activities, when you pay back a loan or buy back share capital. Above financing activities, we have cash flow from investing activities. Investing activities most commonly relate to the sale or purchase of non-current assets or investments in stocks and shares that sit outside of a business's core operations. When a business invests in non-current assets, cash flows out because we have to pay the suppliers cash for these assets. And on the flip side, when we sell these assets off, cash flows back in. Here, the Chudley Cannons have $15,000 of cash inflow from the sale of PPE, which is shorthand for plant, property, and equipment, and $70,000 of cash outflow from the purchase of PPE. They are a Quidditch team, so they might have received the $15,000 by selling off their old broomsticks in order to buy some of those new Nimbus 2001s, which cost them $70,000. This is an investing activity, not an operating activity, because buying and selling broomsticks is not the Chudley Cannon's core business. The broomsticks are long-term investments, which makes them non-current assets. This is different to inventory, which describes assets that are intended to be sold during the ordinary course of business, which brings us on to the first section of the statement of cash flows, cash flow from operating activities. Operating activities are the principal revenue-generating activities of a business. That sounds like a mouthful, but it just means the cash that we receive or pay out during the course of our regular business. Cash comes in when our customers pay us based on our accounts receivable, and cash flows back out when we pay our suppliers based on our accounts payable. Now, at the start of the video, I mentioned the direct and indirect methods of preparing a cash flow statement, and I haven't brought them up again until now because everything that we've covered so far is identical under each method. Operating activities is the only section that's different. So, the direct method. Under the direct method, the cash flow from operating activities is laid out just like a cash basis income statement. Under the cash basis of accounting, revenue is recognized when cash is received, and expenses are recorded when cash is paid out. When you work out your operating profit under this method, it should match your cash flow from operating activities. Let's check back on the Chudley Cannons. This cash flow statement has been prepared under the direct method. So under operating activities, we first have cash receipts from customers of $228,000. The Cannons are a sport team, so I would assume that the majority of these earnings would come from ticket sales and the sale of merchandise. This $228K of cash in would match their revenue for the same period if they were cash accounting. But we can see that their income statement and balance sheet have been prepared under the accrual basis. We know this because their income statement shows depreciation, which is a non-cash transaction, so it wouldn't show up in an income statement prepared under the cash basis. Their balance sheet also contains inventory, receivables and payables, none of which would appear in a cash basis balance sheet. So we've covered cash receipts, but the next 4 lines under the cash flow from operating activities all relate to cash paid out. Cash paid out to suppliers, employees, interest paid, and income taxes paid. When you compare this to the income statement, you can see that each line relates to one of the expense types. Cash paid to suppliers relates to cost of sales. Cash paid to employees relates to the salaries expense. Interest paid relates to the interest expense, and income taxes paid relates to the income tax expense. There is no depreciation in this cash flow statement because depreciation is a non-cash transaction. So that's the 3 sections of the cash flow statement. And when we subtotal these, we get $70K of cash in from operating activities, $55K of cash out through investing activities, and finally, $20K of cash in from financing activities. If we add all these together, we get a net increase in cash of $35,000, which reconciles back to the movement of the cash balance in the balance sheet. A closing balance of $185K less the opening balance of $150K is also $35,000.
Before we move on, I've got something that you should check out. Here's my all-in-one accounting cheat sheet bundle. Inside, you'll find a set of easy-to-follow reference guides. They cover both the direct and indirect methods of preparing a cash flow statement, along with loads of other core accounting topics. They're designed to save you time and make tricky concepts simple. You can grab your copy by heading to accountingstuff.com/shop or click the link in the description. Right, let's move on. We're going to build a cash flow statement from scratch using the direct method.
So here we have the cash flow statement for the Chudley Cannons, and the plan is we're going to recalculate all of these numbers directly from the income statement and balance sheet for the same period, the 31st of December. We will start at the top with cash flow from operating activities and work our way down through all 3 sections to cash flow from financing activities. We are using the direct method today, so cash flow from operating activities mirrors the layout of an income statement prepared under the cash basis. So we have cash receipts from customers at the top, which reflect our sales, and below that we have cash paid to suppliers, employees, and the rest of the expense types. Operating activities are the principal revenue generating activities of a business. So this section shows the cash that we receive or pay out during the course of our regular business. The first line item that we're going to calculate is cash receipts from customers, and to do this, we're going to need to look at the movement in our accounts receivable balance. I said in the intro that we'll need some T accounts, so let's draw those out. Accounts receivable is an asset, which is the A in dealer, so it's a normal debit account. That means our opening balance, or our balance brought forward, goes on the left side of the T account because debits always go on the left. The accounts receivable balance increases as we make revenue because when we credit sales, we debit accounts receivable. So sales go on the left side as well. And finally, the closing balance, or the balance carried forward, also goes on the left because it's a normal debit account. Opening and closing balances for normal debit and credit accounts should always be on the same side as each other. On the credit side of the T account, which is on the right, we have cash receipts from customers. Cash received from customers reduces our accounts receivable, and this is what we're looking to solve for because cash receipts from customers ties back to our cash flow statement. Now we've laid out our T account, let's enter some numbers. We get our opening balance from the balance sheet for the previous year. In this case, accounts receivable were $98,000 as at the 31st of December for the prior year, so we can write this down in the T account. Sales come straight from the income statement. This year the Cannons made sales of $250,000, so we need to debit accounts receivable by $250. And finally, our closing balance comes from the balance sheet, this time from the current year. Accounts receivable at the end of the current year were $120,000. So that goes on the left at the bottom of the T account. Now we only have one missing value, cash receipts from customers, and we can work this out using some basic maths. Our closing balance of 120 less our sales of 250 less our opening balance of 98 gives us minus 228. The negative sign signifies that this is a credit, so we write this down on the credit side of our T account. As you can see, this ties back to the 228 that we have in our cash flow statement. All is well. Next, I'm going to skip over cash paid to suppliers and return back to it later in this video because it's actually one of the harder balances to calculate. So instead we move on to cash paid to employees. The balance sheet account that we're going to need for this one is salaries payable. Salaries payable is a form of liability, the L in dealer, so it's a normal credit account. That means our opening balance goes on the right-hand side of the T account because credits always go on the right. The balance on this account increases as the salaries expense goes up because when we debit the salaries expense, we credit salaries payable. So these go on the right. And lastly, the closing balance joins the opening balance on the right-hand side because we have a normal credit account. We are looking to solve for cash paid to employees, which will show as a debit on the left-hand side of this T account. Because when we pay out cash to employees, we reduce salaries payable. This is the only unknown value for us at this stage because we can easily pull the opening and closing balances from the prior and current year balance sheet, and we can get the salaries expense from the current year income statement. So let's do that. The prior year balance sheet shows a closing balance in salaries payable of 30. The current year income statement shows a salaries expense of 80. And the current year balance sheet shows a closing balance in salaries payable of 42. Let's write these down in the T account and work out cash paid to employees. Our closing balance of negative 42 less the salaries expense of 80 less the opening balance of 30 gives us cash paid to employees of 68. This number is positive, so we debit the T account by 68. And does it tie back to our cash flow statement? Yes, it does. Perfect. Next up, we need to work out interest paid. We're going to run through this one a bit quicker because the balance sheet account that we use to work this out is interest payable, which is also a liability. So the process is very similar to cash paid to employees. That means that the opening balance, the interest expense, and the closing balance all go on the right-hand side of the T account because interest payable is a normal credit account. On the left side, the debit side, we are looking to solve for interest paid, which should tie back to the cash flow statement. We are again going to look for the opening and closing balances in the respective balance sheets and for the interest expense in the income statement. So here we go. The prior year balance sheet shows a closing balance in interest payable of 2. The current year balance sheet shows a closing balance in interest payable of 3, and the current year income statement shows an interest expense of 8. So let's enter these into our T account to work out interest paid. Our closing balance of -3 less the interest expense of 8 less the opening balance of 2 gives us interest paid of 7. It's positive, so we debit the T account by 7,000. When we check back against the cash flow statement, we can also see interest paid of 7,000, so it matches. The last line in cash flow from operating activities is income taxes paid, which we will work out now. The balance sheet account that we're going to need for this one is income tax payable, and since that's also a liability, the process is going to be very similar to the previous two examples. The opening balance, the income tax expense, and the closing balance go on the right-hand side of the T account because we are dealing with a normal credit account. On the debit side, we have income tax paid, which we are solving for. The opening and closing balances will again come from the balance sheets, and we will get the income tax expense from the income statement. The prior year balance sheet shows a closing balance in income tax payable of 4. The current year balance sheet shows a closing balance of 6, and the income statement shows an income tax expense of 9. We enter these into the T account to work out income tax paid. Our closing balance of -6 less the income tax expense of 9 less the opening balance of 4 gives us income taxes paid of 7, so we debit the T account by 7,000. And this ties back to income taxes paid in the cash flow statement. Whew, how do you find that? Brace yourselves because we're about to take on something a bit more challenging. We're going to head back to cash paid to suppliers, which we left out earlier, and I'll show you how to calculate it. The balance sheet account that we need here is accounts payable, which is a liability. Now you might be thinking, but James, we just did 3 liability T accounts. Isn't the process going to be exactly the same? Bear with me for a moment and I'll explain why it's different. We lay out the accounts payable T account as we've done before. The opening balance, inventory purchased, and closing balance go on the credit side, and cash paid, which we're solving for, again goes on the debit side. We can easily pull the opening and closing balances from the prior and current year balance sheet. In this case, we have an opening balance of 95 and a closing balance of 105. So all we need now is inventory purchased, and we're on our way. But how do we find inventory purchased? There isn't an inventory expense in the income statement. All we have is cost of goods sold. Bummer. What we have to remember here is that we're accounting using the accrual basis. And under the accrual basis, we apply the matching principle, which states that revenue and all expenses incurred in order to generate that revenue need to be recognized in the same accounting period. Now, what that means for us in the context of this example is that when we purchase goods from suppliers that we intend to sell, we can't immediately recognize an inventory expense in the income statement. That's because our intention is to sell our inventory in order to generate sales. And if we're generating sales, then the matching principle is telling us that we need to recognize those sales and their related expenses in the same accounting period. In order to do that, we need the help of another account, inventory. Having an inventory account means that we can store the costs of all goods that are intended to be sold as a debit balance in the balance sheet. And when they are sold, we decrease inventory in the balance sheet and increase cost of goods sold in the income statement. Let me explain this using an inventory T account. Inventory is a form of asset, which makes it a normal debit account. So the opening balance, inventory purchases, and the closing balance go on the debit side. On the credit side, we have cost of goods sold. We can easily find the opening and closing balances by referring to the prior and current year balance sheet. Here we have an opening balance of 68 and a closing balance of 94, which we will write down in our T account. And we can find cost of goods sold in the income statement, which in this case is 60. So we write 60 on the credit side of the T account. because when we sell inventory, we debit the income statement to recognize the expense and we credit inventory in the balance sheet to reduce our assets. That leaves us with inventory purchases, which we can work out using the other numbers. A closing balance of 94 less the opening balance of 68 and adding back cost of goods sold of 60 gives us inventory purchases of 86. So we debit the T account by 86. You might have noticed already that it was inventory purchases that we were looking for in our accounts payable T account. So we can copy the 86 over to the credit side of accounts payable, because when we purchase inventory, we debit inventory to increase it and credit accounts payable to increase the amount that we owe to suppliers. Now that we've worked out that number, we're on the home straight to calculating cash paid to suppliers. Our closing balance of negative 105 less inventory purchases of 86 less our opening balance of 95 gives us cash paid to suppliers of 76, which goes on the debit side of the accounts payable T account and ties back to our cash flow statement. Ouch, did you survive that? Cash paid to suppliers is definitely one of the hardest numbers to calculate under cash flow from operating activities. If you'd like to learn more about accrual accounting, then I'll throw a link up here to a video that I've made about it previously. So that was cash flow from operating activities, and when we subtotal all of these numbers that we worked out, we can see that the Cannons have generated $70,000 of cash inflow from their core operations. But hold your horses, we're not done yet. Next up, we have cash flow from investing activities. Investing activities most commonly relate to the sale or purchase of non-current assets, or investments in stocks and shares that sit outside of a business's core operations. In this cash flow statement, we have cash flowing out of the business from the purchase of plant, property and equipment, or PPE for short, and cash flowing back in from the sale of PPE. You might have guessed it already, but the balance sheet account that we need to calculate these numbers is plant, property and equipment. This account is an asset, which is the A in dealer, so it's a normal debit account, and therefore our opening and closing balances go on the left-hand side. On the credit side, we have the depreciation expense because the value of non-current assets reduce as they depreciate. Credit non-current assets in the balance sheet, debit depreciation expense in the income statement. Now I don't want to overcomplicate things in this tutorial, so we're going to keep PPE simple and make a few assumptions at this point. We're going to ignore accumulated depreciation, assume no gain or loss on disposal, and that all cash related to these transactions has changed hands. And finally, that the Cannons spent $70,000 purchasing PPE this year. I know that's a lot of assumptions, but we don't have a fixed asset register for this example, so we'll leave it at that. I'll probably do a whole video in the future covering fixed assets and depreciation. Now that we've cleared that up, all that's left to include are cash paid to purchase PPE and cash receipts on the sale of PPE. The prior year balance sheet shows a closing balance in PPE of 202. The current year balance sheet shows a closing balance of 234, and we can see that the depreciation expense in the income statement was 23. I just said that we can assume that the Cannons spent $70,000 on the purchase of PPE and that all their cash has changed hands. So we would credit cash by 70 to decrease it and debit PPE by 70 to increase it. That leaves us with cash receipts from the sale of PPE on the credit side, which we now need to solve for. A closing balance of 234 less cash paid of 70 less an opening balance of 202 and adding back the depreciation expense of 23 gives us cash receipts on the sale of PPE of 15. So cash would be debited by 15 to increase it and PPE would be credited by 15 to decrease it. Both cash paid to purchase PPE and cash receipts on the sale of PPE tie back to our cash flow statement. And when we subtotal all of these, we see a cash outflow of $55,000 from investing activities. Cash flow from investing activities is an important section of the cash flow statement because it can significantly offset the cash flow generated from operating activities. Last up, we have cash flow from financing activities. And don't worry, we've got all that hard work out of the way. This section is going to be quick. Financing activities relate to transactions involving a business's owners or lenders. In this case, we're dealing with lenders because we have proceeds from long-term borrowings of $20,000, and the number is very simple to calculate. We take the closing balance of long-term borrowings in the current year balance sheet of 100 and we take away the closing balance from the previous year of 80, 100 less 80 is 20. So we have a net cash inflow of 20,000 from financing activities. Now let's take the total of all these cash inflows and outflows that we have worked out. We can see that the Cannons have a net cash increase of $35,000 for the current year, which ties to the movement in the cash balance, which we can see below, and which we can get from the balance sheet. The closing cash balance for the current year of 185, less the closing balance from the prior year of 150, gives us a $35,000 increase in cash. So there we have prepared the Chudley Cannons cash flow statement using the direct method, working out all of the numbers manually using the income statement and balance sheet.
Whoa, that was hard work, wasn't it? And this is only a simple example. You can imagine that this whole process is more complicated for larger companies with more complex transactions, which is why most of them actually avoid this process altogether, because it can be too expensive and time consuming for their accountants to work out cash flow using the direct method. The majority of large corporations tend to opt for the indirect method instead, which is the subject of our next video. You heard the man. This time we're going to build a cash flow statement using the indirect method. Let's do it. So what's the difference between the direct and indirect method anyway? The cash flow statement, along with the income statement and the balance sheet, make up the three major financial statements. We use the cash flow statement to summarize the movement of the cash balance in the balance sheet over a period of time, typically a quarter or a year. And we do this by summarizing all of the cash inflows and outflows into three categories: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. The latter two sections, cash flow from investing and financing activities, are completely identical whether using the direct or indirect method. The only section that's different is cash flow from operating activities, which is why I want to focus on that one in this video. Operating activities are the principal revenue generating activities of a business. These are the transactions that take place on a regular basis. Under the indirect method, there are 3 steps to calculating cash flow from operating activities, and I'll take you through them right now. First of all, we need the business's net profit or loss, which we can find in the income statement. This method relies on starting off with net profit and adjusting it for non-cash transactions again and again until we're left with only net cash inflow or outflow. Most large companies account using the accrual basis, which means their profit does not equal their net cash inflow. Under the accrual basis, revenue is recognized when it's earned, not when cash is received, and expenses are recorded as they are incurred, not when cash is paid out. So revenue doesn't equal cash inflow and expenses don't equal cash outflow, which brings us on to the second section. We need to add back all of the non-cash expenses that exist in the P&L. Typically, non-cash items relate to things like depreciation, amortization, or the gain or loss on disposal of non-current assets. These don't represent cash outflows, but they are deducted in our income statement when coming to that net profit. So it's logical that we need to add these back in order to remove them from our calculation. The third and final step is that we need to adjust for the movement in working capital. Working capital is simply current assets less current liabilities. Current assets are generally made up of inventory and receivables, whereas current liabilities are made up of payables. To work out whether you need to add or subtract these movements in the calculation, you need to consider the impact they have on the cash balance. An increase in inventory means a business has less cash because it has bought more inventory than it has sold. And on the flip side, a decrease in inventory means a business has more cash because it has sold more inventory than it has bought. The situation with accounts receivable are very similar because they are also assets. An increase in receivables means less cash has been recovered from customers, so the cash balance goes down. And a decrease in receivables means more cash has been collected, so the cash balance goes up. On the other hand, payables are a liability, so they work the opposite way to inventory and accounts receivable. An increase in payables means more cash because less has been paid out to suppliers who the business owes money to. And lower payables means less cash because more has been used to pay the bills. Cash flows from non-current assets and non-current liabilities
tend not to be included under cash flow from operating activities because they're normally categorized in the other two sections: cash flows from investing activities and cash flows from financing activities. Now that we've worked out the basic calculation for cash flow from operating activities, let's practice using this template with a worked example. We'll continue with that Chudley Cannons example that I took you through in the previous two videos. Last time I showed you how to calculate cash flow from operating activities with the direct method, and today I'm going to show you how to do it using the indirect method instead. And we're starting right now. Step 1. We first need to jot down the net profit figure because this is our starting point that we will make adjustments to in order to come to that net cash flow. Net profit can be found easily at the bottom of the income statement. In this case, the Cannons have made a net profit of $70,000 for the year, so we write this down at the top of the calculation. Next, we have step 2. This is where we need to add back all of those non-cash expenses that are shown in the income statement. We've got to reverse these out of our net profit in order to get closer to the cash flow figure. To do this, we look over the income statement and search for any depreciation, amortization, or gain or loss on disposal of non-current assets. In this case, we can only see depreciation of $23,000. So we need to add back 23 into our calculation to adjust for depreciation. Finally, in step 3, we need to adjust for the movement in working capital. Like I said before, working capital is made up of current assets less current liabilities. Let's have a look over the balance sheet and see what current assets we have. I can see cash, accounts receivable, and inventory. Plant, property, and equipment is a non-current asset which affects cash flow from investing activities, so we can ignore that. And cash is what we're reconciling back to in the cash flow statement, so we can ignore that one as well. We are left with only inventory and accounts receivable. A closing balance in inventory of 94 less the opening balance of 68 gives us an increase in inventory of 26. Increases in inventory are represented as deductions in calculating cash flow from operating activities because the business has spent cash on purchasing the raw goods or by manufacturing them, so we enter negative 26 into our calculation. Now let's look at accounts receivable. Here we have a closing balance of 120 and an opening balance of 98, which gives us an increase of 22 during the course of the year. Increases in accounts receivable need to be deducted from our net profit in calculating the cash flow from operating activities, because higher receivables means that less cash has been recovered by the business from its customers. So we enter negative 22 into our calc as well. That's the movement in our current assets, but we also need to find the movement in our current liabilities so that we've considered all of the working capital. Reviewing the balance sheet one more time shows us that our current liabilities are made up of accounts payable, salaries payable, interest payable, and income tax payable. Long-term borrowings, as suggested by their name, are non-current liabilities which relate to cash flow from financing activities, so we can ignore them here. Whereas share capital and retained earnings relate to equity, so these can be excluded as well. We are left with only these 4 current liabilities. The sum of their closing balances is 156, and the sum of their opening balances is 131. When we take the difference between these numbers, we have an increase in payables of $25,000 during the year. Increases in payables need to be added to our net profit in order to calculate cash flow. That makes sense because you can imagine that if a business doesn't pay its invoices, then it gets to hold on to its cash. So we add back 25 in our workings. Boom, that's steps 1 to 3 completed. All that we need to do now is take the total of those numbers and we're left with a net cash inflow from operating activities of $70,000. That wasn't so bad, was it? We've come to this number using the indirect method, but a quick check of our calculations using the direct method shows that we also came to $70,000 of cash inflow from operating activities. We get the exact same answer using either technique. So which is better? If you've watched my other videos on the direct method, then you'll notice that the indirect method is much quicker, which is why most large companies using the accrual basis of accounting tend to work out their cash flow this way. But if that's the case, then why doesn't everyone do this? I suppose it really comes down to how the workings of cash flow from operating activities are presented in the cash flow statement. The layout using the direct method is far more intuitive to read because it mirrors the cash basis income statement. We have the cash receipts from customers at the top, and below that, we have the cash paid out to all of the various suppliers and stakeholders. It makes easy reading for investors who might be glancing over the cash flow statement to extract meaningful information from it. On the other hand, the layout of cash flow from operating activities under the indirect method is far less intuitive. You can think of the indirect method as a shortcut to working out cash flow from operating activities, which is a win for the accountant or bookkeeper who's preparing it because it saves them time. However, the third parties who are reviewing the finished cash flow statement lose out because this report isn't as useful to them. Like I mentioned earlier, we skipped over cash flow from investing and financing activities in this video because these sections are identical under the direct method.
See, the cash flow statement isn't as scary as it looks, right? If you'd like a handy reference guide to come back to, then don't forget to grab my all-in-one accounting cheat sheet bundle. I have cheat sheets dedicated to the direct and indirect methods, which we just went through. And if you'd like to keep on learning, then why not check out this video next, and I'll meet you over there.